school covering claims and underwriting. After this class is over, we will be sending out a survey asking for your comments on how we can improve this offering. And I hope you take the time to fill that out and give us some very good information. Today's session covers a lot of ground, so we're going to turn it over to Jack Yanoski at this point so he can get started with you. Once again, I ask that if you have any questions, send it directly to us. I think I'm listed as BIS questions. Otherwise, enjoy, and Jack, the floor is yours.
Thanks, Ron. Good afternoon. This session comes in basically two very distinct formats that basically blend together at the end of the day. And the first format is underwriting and the scope of underwriting and what it means and how it works and things of that nature. There's a long-winded definition of the purpose of underwriting, and you can really get wrapped up around it. But I think that you can take a look at it, and the first purpose is to build a book of business, build a book of profitable business for the insurance company. And the second is to maintain that profit through quality assurance underwriting. So if you want to just take it as a recap, the purpose of underwriting is to develop and maintain a profitable book of business. That's the primary focus of what an underwriter's job is. So how do they do it? Well, number one is they're going to grasp and scope from various formats of information, starting with the application. And that's where it's critical that the underwriter and the producer, especially in the appointed atmosphere, this is where the producer is appointed to that carrier and may have one underwriter that they work with, build a good relationship, because you have to remember that the producer is the field underwriter. So the first information that the underwriter is going to see coming in the door is the application, okay? And then what the underwriter is going to do, they're going to grab that application and they're going to match that to that little known, little seen proprietary paperwork called underwriting guidelines. Now, the guidelines are developed by the insurer, and they are proprietary to each insurer. They may have certain things on there that what they want done, what they don't want done, risks that they may take, that they may not take, and exceptions. But all of these underwriting guidelines still have to meet the insurance laws. They cannot be unfairly discriminatory. And note, keep that in mind, that it's in the insurance world, it's always unfair discrimination. Insurance companies can discriminate fairly. Okay, if they don't write under age 21 as a preferred risk, they can't write anybody under 21 as a preferred risk. If they don't write anybody with 2 tickets in the past 3 years, they're not supposed to write anybody with 2 tickets. They can't bend that rule and say, oh, well, this guy's the third cousin twice removed of the vice president and we'll give him a policy. Can't do that. As long as you discriminate fairly, you're okay. When you go to the unfair discrimination is that you cross what we refer to in Pennsylvania as Act 205, the Unfair Insurance. So you can't discriminate by age, sex, employment, religious belief, national origin. Those are definitely carved into the insurance laws that you cannot use those. You can use driving record. You can use type of vehicles. You can use the accidents. You can use violations, minor, major. As long as you set these guidelines in a uniform manner, they can be set up. So where do you go? You take the four real stages of underwriting. Okay. First is for the underwriter to obtain the information. Okay, and they get this information from various sources. They can obtain this information first, like I said, from the application. And the producer should complete this application accurately. That's the first step. Okay, then you have other sources that the underwriter can pull from. They can go in and they can pull from credit reports. They can pull from basically government records. So the government record, if you're underwriting auto, would be the driving record. You would check the registration. Is the vehicle registered in Pennsylvania? If you don't write vehicles not registered in Pennsylvania, you want to make sure it has the blue, yellow, and white tag on it. Is it a vehicle that you do not have on the excluded list? Now, in today's market, almost all the vehicles are acceptable up to a dollar limit. But years ago, certain high-performance vehicles, like back in the 70s, a Firebird Trans Am was not acceptable in a lot of markets. Jeep Wranglers back then, the CJ5 and CJ7 were not acceptable. So you would want to follow those. If those guidelines are set and you still do not write a Jeep CJ5, if somebody has a CJ5, you shouldn't take the risk. If they have a regular Wrangler, what they call the X Wranglers, the X series, and that's acceptable. So you want to obtain all that information. You can obtain credit reports. You can obtain loss histories, and many underwriters on the P&C market use the Mutual Inspection Bureau. Did the person have a loss? Now, on the side of training a producer, when I was in the industry and I had to do this task, some of the keys were, it's the way you ask the question. And even as an investigator for the department, it's how you ask the question as to the answer you're going to get. So I used to train producers, and underwriters should work with producers to sort of help them, especially new producers, follow this format. Most of the applications are going to have a question that says, have you had any losses in the past 3 years? Any accidents in the past 3 years? Okay. And what the application is actually looking for, the underwriter is looking for, is at-fault losses. Okay. Because if they're not at fault, you're really not interested. But people sometimes don't differentiate between fault and at-fault. So instead of saying, have you had any accidents in the past 3 years, what the producer should say to the person is, when was your last accident? That forces them to think. Because if somebody says, well, when was the last 3 years? Now you're going back to February of 13, and they're liable to think, was that accident at the end of 12? So it's outside that. But if you say to the person, when was your last accident? You force them to think and say, oh, I think it was February of 12. Well, if you're looking at 3 years, you're fine. If you're looking at 5 years, then you've got an accident on record. The same thing with moving violations. When was your last moving violation? You don't have to ask the question verbatim to the application. What you have to ask and obtain is the intent of the question on the application. Because if it's answered incorrectly, it's misrepresentation. So you want the most correct answer you can obtain. So sometimes underwriters have to work with producers to obtain that. All of this information is out there. So you can obtain loss histories, you can obtain credit reports. All of this information is grasped by the underwriter to make the decision. Now they have this information. Now they're going to move to the decision process. The decision process for an underwriter is usually one of three. They're going to issue. Simple. They're going to deny or decline or refuse to issue. Or in some cases, they could issue the policy with modifications. Now, in the P&C world, that may be an adjustment to the rating. Okay, well, we discovered a loss that wasn't disclosed, but you know what? We're still willing to take the risk because how long ago it was, and it wasn't all that much consequence, but they don't get the preferred rate. They'll get the one step down because most companies are on tiered rating systems now rather than having two distinct companies writing standard and preferred. They can do that. Now, in the life and health market, that occurs more often than it does in the P&C, where they will say, okay, well, this person has an occupation of one type. Many years ago, underground coal mining carried what was called an occupational rating. Okay, so if you were buying a standard life policy and the premium for that policy was $50 and you worked in the underground coal mining, then your premium may be $58. If the producer quoted it that way, it was fine. If the producer didn't quote it that way, then the company would issue the policy with the rating modifier on it, wouldn't require another signature that the person knows what they're getting. And that could occur in the health market. Maybe not too often now, but years ago, they would maybe put a waiver on it that they wouldn't cover a certain condition that the person had within the last 3 years for the next 2 years. But with the pre-X basically null and void in most cases, it doesn't exist today. But those are the three choices that an underwriter usually has. They can issue the policy as applied for, decline acceptance, or issue the policy modified in some manner, rate, benefits, what have you. Then the next step the underwriter has to make to go to is, after they've made their decision, they have to implement that decision. So now they have to communicate it. And most often it's communicated back to the producer. Most underwriters do not really have one-on-one contact with the proposed insured. Unless they are a direct write company, most underwriters will work through the agent to obtain the information, or the producer. But that doesn't, once they implement it, so they issue the policy, that doesn't mean that their job is done. It's done for that day. It's done for that day on that policy, but they have to follow that policy. And a good underwriter, when that policy comes up for renewal, if it's an annual policy, will check that record coming up there. But you can't check it in 1 year. There are laws in Pennsylvania that tell you when you can check it. So if you know that this auto policy has had 2 at-fault accidents in that first year, and they break the threshold, we'll just say one of them is a minor fender bender, $700 or $800, but the other one's a $3,500 claim. While the underwriter may want to get off, the underwriter can't wait until the 12th month anniversary of the policy to come up to renew to say we don't want it. The underwriter can't call the agent and say, hey, we forgot to send the notice out, but if they want to make a payment, don't take it. What you have to do is about 75 days before the renewal date is pull the claim file and see, are the claims settled? Is everything fine and dandy? And issue a notice at least 61 days in advance. It's a 60-day notice to non-renew an auto policy, personal auto policy, but you cannot count the date of mailing. So underwriters have to stay on their toes. You know, an underwriter has quite a volume of book of business. So you're looking at new business all the time, and you're looking at renewal business all the time. So underwriters can be pretty hectic and pretty busy. So they depend a lot on technology. Just like every other business in America now is technology oriented, and they can pull and grasp information in the files. They can actually have the file triggered to kick it up. So if someone writes a policy on an individual, there's no losses, it wouldn't trigger up on renewal. You can, one of the programs used often by the insurance companies, and they tie it to the agencies, is a program called ImageWrite. And the ImageWrite helps them. It helps them in a number of ways. Okay, first off, it sets the agent basically is communicating directly with the underwriter. Keep in mind that there's a focus in the profitability, is that the more losses a company has, the more adverse their selection, the more money they're paying out, the chances are the company is going to have to do one of 2 things: abandon a market or raise premiums significantly. So good underwriting, there's the second purpose of good underwriting, which goes in hand in glove with the profitable book of business, is to minimize poor risk selection. Okay. Now, some companies are tiered that they will take adverse risks that have 2 or 3 claims or multiple violations, but the tiering is down to where the premium is significantly higher. So that keeps on, that's an ongoing, underwriting is an ongoing business. You just don't issue the policy and it's gone. Same as a producer. They don't just write the policy, submit the app, and it's issued and they're done. It's constantly an ongoing relationship with the client and the company.
Jack, earlier in your review, you mentioned something about underwriting guidelines. Are underwriting guidelines something that carriers need to file with the department? And does the department approve these underwriting guidelines? Can anybody inspect underwriting guidelines? Any competitors? Like a rate filing, for example, once approved, can be inspected by anybody's competitors.
Now, underwriting guidelines are proprietary to an insurer, so they're not really filed with the department for pre-approval. And so really the open market, one company cannot look at another's. However, the department can look at the underwriting guidelines on a market conduct exam. And the licensing and enforcement area of the department, investigating a complaint that involved unfair practices, could look at the underwriting guidelines. If those underwriting guidelines were discriminatory and violated the law, then the insurer would have to change them, and two, the insurer would be more than likely penalized for having guidelines that violated the law. They can't, they have to be very, very cautious. And there are consent orders out there where underwriting guidelines and practices were caught where insurers would say, and you have to have 5 years experience to get a preferred rate. Well, that discriminates on anybody under 21 in Pennsylvania. There's no possible way an 18-year-old can have 5 years driving experience unless he counts 2 years or 3 years of driving the farm tractor. And they're not going to count that because he's not licensed. And there were companies that were brought to task for that through enforcement actions of the department because it is discriminatory in that manner. And there were some companies that actually said, we won't write anybody a policy that doesn't have 3 years. Well, how does a 16 or 17-year-old get their own insurance? And an 18-year-old may not get a license until they're 17, and now they're off and they're working, they cannot get any insurance. So they have to watch how they phrase these guidelines. But generally, they're proprietary. They're not seen to the public, and the only time the department would look at them was if they had just cause on an exam.
So one of the newer concepts in underwriting deals with the use of initially credit scores and now insurance scores. And in my review of rate filing, I never see those terms used within the actual rate filing itself. So how can companies use insurance scores or credit scores in Pennsylvania's market?
Well, they would set their guidelines, their underwriting guidelines, to say an individual has a credit score, say, of over 650. That was one of the first hurdles to get into the preferred tier, companies that are tiered. And that wouldn't violate the Unfair Practices Act as long as everybody that does not get into that tier has a credit score below that tier. Once they make the exception, now they're starting to get to the point of unfair practices. So underwriters have to be cautious. That's not to say that if an app comes in and the person has a 629 score and you're looking at 650 and they have a new vehicle and they have everything else, that the underwriter wouldn't make an exception. But they have to be very careful when they make that exception, because the exception that gets declined to another carrier, if somehow, some way, finds out that somebody got one, well, 629 got one, I had 628 and I didn't get it, but the cutoff is at 650, the company's going to have to explain that. If the cutoff is at 630 and they give someone one at 630, maybe somebody one at 629, but they don't give someone at 600, they probably could defend that. But they have to be very careful when they're making exceptions. And we'll deal with that even in the claims process. Once the company decides to avert its standard process that it has established and treat similarly situated insureds differently, they're crossing the line and violating the Unfair Practices Act.
So the simple answer is that we wouldn't see the use of a credit score or credit or insurance score in the rate filing, but you would likely see it in the actual underwriting guidelines.
Correct. Right. They wouldn't make it public. Now, they're not required to. Nothing says an insurer can't do it.
Well, I understand.
But we don't ask for it. The department doesn't ask for it.
So does the department have a rule? So you get a policy, and during some time after the policy's been issued, a year, 2 years, your credit score deteriorates. Can the company then change your rate solely upon the use of that changed credit score?
Well, they're not supposed to do that because the Practices Act doesn't allow them to reevaluate the initial underwriting. Okay, what they should be doing, is looking at the driving record or something of that nature. Okay. But they just can't up and say, you were late paying your electric bill because you were unemployed for 3 months and your credit score went from 801 to 600. So now we're going to raise your premium because you're not in the same tier. That doesn't have anything to do with the risk they accepted.
That's actually a good point because the insurance commissioner issued her notice against the use of price optimization, basically using the argument that you just made on the auto law, where there are very few enumerated reasons to increase an auto rate, and that price optimization violates that, that rule, at least in her opinion. Secondly, the credit score itself would be the same thing. It's not one of the enumerated reasons to increase a rate. Therefore, you can't increase that rate.
One of the, historically, and I know you were there and I was there, when they first came in, the actual credit score company that came in to meet with the department was called Fair Isaac. And the commissioner at the time was Diane Kochen. And a gentleman working for one of your mutuals was our chief actuary. Why I was invited, the director in consumer services at the time was on maternity leave, so I got to go for her. And we asked several questions of the company on how they developed this rate, and he wouldn't answer the question. And so one deputy, and I even asked it because several years before that, I'd gone through a divorce, and we had joint accounts. And we had to terminate those joint accounts, and I had to get new accounts. And according to the Fair Isaac score, my credit rating would be significantly reduced. And I tried to determine with personal questions is if I had $25,000 in credit and I abandoned the joint accounts and got $25,000 in credit back, how did my profile change? And he wouldn't answer. Then a deputy who had just recently gone through one and apparently had some experiences on it became a little more irritated when the gentleman wouldn't answer the questions. Part of the problem with using a credit score and saying that we're basing this on this is that no one has a grasp on how that number was arrived at. And so it's difficult to use. So it can be a tool that is used, but you can't solely base on it because no one other than the company that developed it would be able to answer the question as to how did your credit go down, Ron, and mine go up if we were similarly situated or vice versa. Okay, so that was very, very difficult at that time to deal with. But they do use it. There is reflective to it. And there's another program that they use a lot of, which they'll go out and they'll say that in an area, if somebody is living in an area and they own a home that's worth $200,000, they have 3 cars, and they're 40 years old and this and that they're more likely to have this if they're driving so far. It's called predictive modeling. And the problem with predictive modeling is it makes more generalities than it does a focused risk analysis. It's a tool. And don't get me wrong, the insurance industry uses a number of tools, but to solely rely on any one tool could actually leave the company open for lawsuits, regulatory action that they don't need. They're better off having a toolbox rather than a single tool to use.
The question on
Sure.
Insurance scoring, though, if even though credit scoring presumably doesn't discriminate on the base of race or sex or whatever, if I have an area, a specific geographic area, where everyone shares the same demographic of low income, unstable jobs, length of tenure in a location, pretty sporadic, and so that means that everybody in that area kind of has a poor credit score. And so they are forced to pay a higher premium or a higher tier. Some political people have suggested that that is a form of redlining, although be it economic redlining. I guess my question is that accusation still gaining traction? Is there still the same level of criticism against the use of insurance scores?
Well, I don't know if it's exactly the same, but that is one of the focuses. Simply living in an area that is not as affluent as another, maybe having seasonal work, you work in construction or something, so you work 9 months of the year. Does that really make you less of an insurance risk or more likely to have a claim than someone who, say, works for the state lives down in Cumberland County, in a more affluent area or in a better area, Harrisburg, and has a full-time job, 12 months of the year. No, not really. I mean, we had several years ago, and you may remember this, Vince, it was right after I landed in Harrisburg, there was a hit and run on Cameron Street. Okay? Now, you would stop and think that it's probably somebody that, was, what, like you described, less affluent, partial. Happened to be a state representative who was out having a few drinks with his staff, and it was hit and run. And then he disposed of the vehicle to where it became a criminal action. So how does having a seasonal work, not living in a super well maintained home in an affluent area, how does that insurance score match up against someone else? On paper, it looks good, but in the reality of the performance of it,
Jack, I'd like to give a little bit more color to the answer. When you look at what the credit score is actually measuring, it's not measuring household wealth at all. In fact, it doesn't include anything to do with your wealth. It has to do with how you use your credit. That's the credit score itself. And the insurance score takes part of the credit score plus how your insurance history plays out into it. So you could be a very wealthy person and use your credit very unwisely and have a very bad credit score. So getting back to the issue that you said about geographic areas, the reality is it doesn't matter. There may be a preponderance of people that are low income in a particular. It doesn't always relate directly to a low credit score. There is evidence to show that there may be an overuse of credit in low-income households, which then, if you're not using it properly, could result in a lower credit score. But everybody in that area, regardless of your wealth, when you meet their criteria, would have that same credit score and get treated similarly. So they call that the disparate impact argument. And on the surface, insurance regulators have looked at it very, very closely, and so have the actuarial task force at the NAIC, and have concluded generally that it is not a unfair insurance practices. However, the federal government has looked at this issue, and actually up in New York State, the Department of Housing and Urban Development actually issued some penalties on loan originators related to the use of credit scores and using the disparate impact argument. So the bottom line is the argument's not dead. It's still alive and well, and consumer activists do tend to still try to keep regulators and the industry honest by making these types of arguments.
Now, the other insurance scoring question that insurance agents have raised to me is that if, for example, if I go to a bank and I apply for a loan and they say, no, that is clearly an adverse decision, which means that the fair credit legislation kicks into play and I've got certain rights of appeal, and most important, I have to know why I was declined. Now, if someone is put into a higher premium tier because of their insurance score, is that also considered an adverse decision? Does that entitle the customer to accessing the methodology behind the credit score, i.e., why did I get charged more for insurance than I thought I should have been?
yes, it does. Yeah, sometimes it's very simple. If they're going to use the insurance score, that's going to have to go back to the carrier. Okay, but sometimes the agent could say, hey, we found like I said, they said they had an accident in 2012, but it actually turned out to be in the fall of 13, not the fall of 12, and the rate is adjusted up. Well, the agent can answer that, and it's pretty easy to answer. So anytime that there's an adverse action, whether the tiering goes down, the premium goes up, the policy is rated, the insured is entitled to an explanation. Okay, some are easy, some are hard.
But an explanation from the carrier, not from the insurance producer who doesn't have access to proprietary company information.
Well, yeah, on the insurance score or the true application of the underwriting guideline. That one, only the carrier can answer. Now, the carrier can choose to answer it through the producer if they're appointed because they're a representative of the carrier and give them the information to answer it. You know, which if I was an underwriter, that would be my choice. Okay, you're the producer, I'm the underwriter. You call me up and said, hey, this one went up. This guy wants an answer. I give you the answer and you convey it. Okay, that maintains the same track as the business coming in as the answer is going back. Okay, that's the way it should be done. Okay. Now, another benefit to good underwriting, really good underwriting, is an insurance company cannot expand its book of business if there are underwriting losses. Okay, so if you're basically taking on bad risk, what's going to happen is your premium is not going to be able to cover your losses. So that's called capacity. So in the insurance capacity to take on additional business is hinged solely on good underwriting because you need to increase your earned premium, not the written premium, the earned premium. So when you're looking at capacity, it's basically capacity equals loss minus earned premium. So if it's a negative, you have a problem. So what you're looking for is if a carrier can keep their loss ratio at 72% and pay out 72 cents on every dollar they take in or less, they're going to be able to expand their capacity. When they start getting up higher, they're going to have to raise premiums. And when they start getting in closer to the 90%, they're probably going to get a visit from the department. And of course, once they get over 100% for more than 1 year, they're probably going to be dealing with supervision of the department or possibly a runoff. So quality underwriting does more than just maintain the profit. It also allows the company to expand, whether it even wants to expand in other markets. They have to have that premium and surplus to expand. So we'll go back over the info sources for underwriters. First, producer, reports. Oh, yeah. Back in reviewing this process, gathering the necessary information. You're going to gather that information from the producer and that application. You're going to obtain consumer reports. You're going to get official record reports, is what I always call them. That's, if you're looking at a driver, you're going to get the motor vehicle record report. You want to get inspection reports. That inspection report, that's a very valuable tool when you're writing a homeowners. If you're writing a home that was built 5 years ago or less, unless it was really poorly maintained or there were claims, you might not need an inspection report. Looking at a home that was built in 1992, 1986, 30 years ago, you want to check the condition of the roof. You want to check the condition of the siding. So you get an inspection report. If everything matches up, you have a little comfort, but you also have a stepping stone to build on. Understand, in Pennsylvania, if you are underwriting personal property and owner-occupied dwellings, or what we just refer to affectionately as homeowners, you cannot get off for claims. The other thing an underwriter has to be very cognizant of is that first 60 days, it's from the day the application makes the policy effective and 60 days. That is your underwriting window. You cannot use an underwriting reason to get off a risk on the 65th day. You can't say that we don't, their shingles are missing or the siding is blown off in the back or there's no handrail. You have the first 60 days. There are adjudications and there are enforcement actions on companies on file where they went over the 60 days or they used an underwriting reason to get off the risk. Nothing says that the underwriter can't look at it and say, wow, there's no hand railing on that deck. There's half a dozen shingles missing up near the top. On the 40th day, they can send a recommendation out and they can say, this policy will terminate. Now, today is February 18th, and today's the 40th day, so I'm the underwriter. I send the notice out to the person. This policy terminates July 1st, 2016, unless repairs are made to reshingle the roof, a railing is put up, all of the criteria that I see that poses a problem to me. And I'm giving them until July to fix it because right now it's kind of tough to make repairs to a roof when it's, well, this morning it was 15 degrees in my house. I wouldn't want to have been out on a roof. But you're doing that. You're issuing the notice within the 60 days. Nothing says the policy has to terminate on the 60th day. The notice has to give that many days, but it does not have to terminate on that day. So you're giving them till July to fix it. At that point in time, you tell the producer or you call for an inspection. And if it's done, you withdraw the termination notice and the policy stays in force, or the notice itself becomes effective.
So Jack, before you go on, I have a little anecdote to share with you. So when Commissioner Joel Ario left the department, over that weekend, Acting Commissioner Bob Prater was appointed. And it occurred over a weekend. So Joel left on a Friday. Bob Prater comes in on a Monday as the acting insurance commissioner. And we had known Bob through his role in the Office of General Counsel. And he calls me, this is when I was serving as a deputy, he calls me up to his office and he says, explain to me what I'm supposed to do with this notice. Turns out that it was a notice that his son had faxed to him, and his son just purchased a house in Pittsburgh, and the insurer had issued a 60-day notice because there was no handrail on the steps. And, the commissioner didn't know what to do with it. And I simply said to him, make sure your son puts the handrail up and everything's fine with it. So, anyway, I just thought I'd share that with you because it was a real world story.
Mm-hmm. Yeah, I mean, most carriers, if they want the risk and there's just a few things that need fixed, will do that. Otherwise, I mean, if it doesn't meet their guidelines whatsoever, it goes south and they don't have to take the risk.
Now, a question on underwriting. First of all, with the growing use of online application, does that in some way affect the amount of underwriting that can be done? Where you see ads that say, apply now, you get your coverage today, no problem, piece of cake. Usually the minimum coverage folks seem to do that. But doesn't it call into question the ability of the underwriter to actually get into the case to see if it's a viable insurance risk?
Not really. What they're referencing there is the ability to bind on that day. And if you look at a temporary receipt for insurance, whether it's life, health, auto, home, okay, the company extends coverage until they make the underwriting decision. They got their 60 days, okay, providing everything's copacetic. Okay, so there's coverage on that day, but the rest goes in. So you apply that day, and Joe Schmo applies online. Have you had any accidents? No, never, none. All of this goes in. The company, even if it's online, a direct write, they issue the binder, and then they pull in the MVR, and 3 days later they see that every other week this guy's had an accident for the last 3 months. They issue the termination notice right away. They're on the risk until the day they say they will cancel it.
So true underwriting can still take place even though if it's an online application.
True underwriting should take place even though it's an online application.
And the great irony here is that the reason why the original 60-day period was there is because it was harder to obtain records, prior to the advent of the internet and other types of things. And now with the commoditization of the personal lines market, you're actually seeing that tool being used in a similar way that had been used 30 years ago to underwrite the risk, even though all the information is actually easier to get to.
The original date, now this does predate me a little bit, but the original date for the auto law in Pennsylvania, where you have the 4 vehicles, covers 4 vehicles, and you have the reasons to count, it goes back to 1968. And the original one for Practices Act goes back to 1974. So, yeah, there was no internet back then, and it did take, in fact, applications could be faxed, but more often they were mailed, so the underwriter didn't even see it for probably a week, depending on where the carrier was located. So now, yeah, they're right. being married to a former senior underwriter who utilized image right. Normally, when the risk came in, within 72 hours, she had all the information she needed to make her decision. Now, the trouble is, there's so much more activity today that back then, you may have had 10 apps getting into an underwriter, and they're being loaded at 10 apps an hour. So it's hectic. So they still need the 60 days because be fair, to make sure they vet everything properly. But yeah, those laws go back and they haven't been changed.
Now, another underwriting issue is the company's appetite for certain questions to be asked that other companies may not. For example, one mutual company asked specifically for the property owner, is there any Marcellus shale exploration or extraction activity going on, or do you have a Marcellus lease of some kind, whereas other carriers don't bring that up. So if the question's not asked and the coverage is placed and the property owner goes through the 60 days without blemish and the field underwriting doesn't catch on to the fact that, say, Marcellus activity is taking place, does the company have legal standing to terminate the policy based on a misrepresentation?
That goes to the old expression, ask me no questions, I tell you no lies. If you don't ask it, then, okay, they can't use misrep. What they could probably do is if they don't accept any commercial activity on a residential property, non-renew. If it goes over to 60 days, they'd have to go to non-renewal, showing an increase in hazard that but they're really going to have a hurdle there because the same hazard exists when they wrote it. But they would have to say that there's commercial activity that takes it out of the personal lines market. That would be about the only defense they had, because you can't. The three primary reasons to terminate a homeowner's non-pay. Okay. The other two for non-renewal are increase in hazard by omissions and negligent acts of the insured and increase in hazard since inception of the policy. So something has to change to increase the hazard. If the hazard is exactly the same, you have to demonstrate the increase. What's the increase? Now, if the Marcellus shale wasn't there, the well wasn't there or whatever, and 14 months later, they renewed the policy once, and 14 months later, Halliburton puts one there, and the carrier finds out. Now they can go to non-renewal for increase in hazard since, they can use either reason, but I would be, if I was an underwriter, I would suggest increase in hazard since inception of the policy, because it's not really a negligent act of the insured to permit somebody to drill on their property, but it is an increase in the hazard. So that one would have to be. Now, the company that asks it and the person says no, and they find out that there was, that's a misrep. They can get off for the misrep there.
But Jack, let's go back to the situation where there is a policy in place. And for some reason, we'll use the example you said that sometime after the policy incepted, a well was drilled either on their property or very close to their property or something like that, where the carrier is now making an argument that there's an increased risk of hazard. Before they can actually non-renew that notice, do they have to give the consumer a right to review and appeal that decision to non-renew?
Well, it would be on the notice, right? They would have to send the notice out at least 30-some days in advance, 30 days plus dates of mailing. And they would have to tell the reason they're non-renewing it, and the wording would have to be, it's by statute, would have to tell them to direct their request to the department within 10 days of receipt, and the department could review it.
Now, the interesting thing here is if it's not something the consumer could remedy, how do you believe the department would look at a situation like that?
Well,
and there was no material misrep
there's no
or any other type of.
If it's on the insured's property, the insured would probably lose hands down, even on an appeal before the commissioner, because what would happen at the department's review? Not necessarily an enforcement action, but it would go to the Bureau of Consumer Services. An investigator there would review it for a statutory purpose and issue an adjudication I'm sorry, an investigative report order. And in that report order, it would either direct the company to maintain the risk, or it would tell the consumer that they're upholding the insurer's termination and give either party, whichever is aggrieved by the uh, report order, rights to appeal before the commissioner. So if the person had opened up a well on their own property for commercial purposes, that would probably stand a review of the commissioner. But if it was on an adjacent property that the insured can have no control over, I'm not sure if I was an insurance company, I'd go after that termination. I think I would, yeah, most companies don't like something within 40 feet. But, if my neighbor puts a well, even at that point, most ordinances are going to make them maintain a distance off the property line and a distance. And surely if Halliburton wants to put a well on my neighbor's property, if they put it in the back, it's going to be more than 40 feet from my house, because they're not going to want a well that generally goes up 60 feet near the house either. So, but I think the commissioner, the department may not, because, an investigator may say, well, that is an increase, in that, whatever. But in that case, as an underwriter, I probably wouldn't issue it. As in working for the department, I would tell them, I think you're out of bounds because this person can't control what their neighbor does. That would be similar to, well, we're going to non-renew your house because your neighbor doesn't have any siding on theirs.
So there's a lot of our mutuals are in the northern tier or in the western part of Pennsylvania, where there is either drilling for oil or gas going on, and has been going on a long time. So in the situation where, in today's market, where you can do, I should know this, where you can angle your drilling from one location underneath into another adjacent property. So you as a property owner sell your mineral rights, gas rights to the exploration company. Now you potentially have a situation where their property is being used for commercial purposes, even though the activity for the drilling and even the production may be on an adjacent, non-owned property. But there still can be a potential risk there, because if they're fracking, you could get, you could have water supplies impacted. You could have, theoretically, you could have small disturbances in the ground as a result of stuff. So in your experience here, not in, because I know none of this has been adjudicated by the department, how do you think it would be looked at?
Well, if my neighbor has a well put on their property, and they, Halliburton or Range come over, or Chesapeake come over to my house, and they say they want to do the lateral drill and come in. And I said, sure, fine. And then all of a sudden I have a loss to my home. 9 chances out of 10, my carrier is going to deny the claim, because 1, earth movement's excluded. So if they lose my water from the outside, okay, that's not a claim. If they crack my foundation from the outside, that's not a claim. If the ground shifts because of that, that's not a claim. If the tower falls over and hits my house, they're probably not even going to know they were drilling underneath it, but that would be a claim as a falling object. So really, my carrier doesn't have a lot at risk there, because everything is underground, and no matter what happens, it's going to fall under the Section 3 exclusions in my homeowner's policy. Yep. 9 chances out of 10 it will. I mean, there might be some off-ball thing there, and that'll even, we can follow that further when we get into the claim section, but
of course, that also brings up the question of what is earth movement, in terms of, I was thinking of the commissioner's statement about earthquakes, whether they be natural or man-made, and didn't know if that would affect any interpretation as to coverage exclusions for earth movement.
Well, Vince brings up an interesting issue. Last spring, the insurance commissioner issued a notice that said if you have a earth movement coverage included in your policy as an endorsement to a policy, and it excludes man-made earthquakes from that coverage, you cannot implement or use that exclusion in making a claims determination. So everything when we do talk about this, it's all in the theoretical because we have not had a major earthquake here or one that even would remotely resemble a man-made earthquake. But the possibility does exist. The interesting side note to this is most of these forms are addendums to homeowners forms, so they have to be prior approved. So I would argue that in the absence of having a disapproval of that form, the form still prevails, and a judge in a court of law would likely have to find that way. Now, I'm not a lawyer, but the department does have the right to disapprove forms. And in this particular case, they did not exercise that right. But that's all theoretical because we haven't seen the situation with the man-made earthquakes like what we're seeing out in Oklahoma and Nebraska, where they're really having major difficulties. We've been talking a lot about the underwriting process, and I know we're taking a lot of time. So, Jack, I think we need to move on.
Okay. Well, we'll recap real quick. Measuring underwriting results, financial and non-financial. Basically, the financial side is number of losses on the book of business the underwriter has issued versus the premium that came in. And again, that's on the earned premium because written, while you can compare it to look at written premium, you have to remember that when you're any of the 60-day terminations, we'll just say $1,000 premium comes in, you're on the risk for 2 months, you're going to give back 80% of that premium. So that's going to be returned. Your earned premium is only the 2 months that you were on the risk. Then you look at the loss ratio, the expense ratio, you can compare it to the combined ratio. All of that takes down, you take that product and you take times 100 to equal the percentage. And again, if your underwriting is at, we'll say 70% or below, it's profitable. If your underwriting is 80% or above, you're probably going to have a talk with your underwriting team that they're taking some risks that they probably shouldn't take. The non-financial, that's, you can take a look at relationships with the producer. You can take a look at how pleased are people with your service, things of that nature. But really, the companies are going to grill on the one that is on the books and is easily identifiable, and that's your financial ratings. So again, underwriting is very important. It goes hand in glove with the insurer's operation, and it really keeps the claims department employed. If they didn't have claims people and they didn't have claims forms, then insurance companies wouldn't expect any, and that would be a shocker. But the primary focus of claims, as we move on to the claim side of it, the goal, pay your covered losses in good faith. That is the primary goal of the claims process. There are 2 focal points, okay? And the first one is to comply with the laws and keep the goals in mind that you're going to pay the claim in good faith, but comply with the laws and paying that claim, the insurance laws, and maintain profitability of the insurer. Okay. I know I've heard in the 40 years I was there that some insurance companies will pay a $3,000 claim because it would cost them more money to contact their legal services. And that may be a fact, and that may be a way to keep it profitable, but they shouldn't make a habit of paying claims that they're not legally obligated to pay. If you look into the insurance statutes of Pennsylvania in 40 PS 1171.5, and you get into there, you're going to see sections in somewhere down around section 8 or 9, it's going to tell you that you should pay claims once your reasonable liability is clear. Okay. And you pay the claim in accordance with the policy. So, you shouldn't try to nickel and dime the claim. I understand the first priority, you think the person is going to try to inflate the claim, they're going to want more. And your goal is to cut less. The claims person, the claims representative should pay the claim in good faith. and in compliance with provisions of the policy. So there are two types of claims. A good claims representative will not treat either type differently. There's a first-party claim and a third-party claim. Simply put, a first-party claim is when the insurance company is paying their own insured, and a third-party claim is when the insurance company is paying a claim to a claimant on behalf of their insured. Now, that's not to say that the claimant can't be also a policyholder, but their policy is not triggering the claim. So, if I hit Ron's car and we're both insured with the same carrier, then the carrier is looking at me as a claimant, and Ron is the claimant, and should treat him the same as they would treat me, even though we're both insured that way. They shouldn't treat the third-party claim any differently. Those are the two types of claims. Typically, your third-party claim could involve litigation, okay? Because if you go out and there's an accident, there could be liability issues, definitely can be property damage or that your insured caused, so they're looking at that. If the accident injures the party, if it's an auto accident or if it's something that happens on a homeowner's property, if it's a commercial loss, then you have the litigation involved. And the first-party claim, I guess I'll ask and answer this since you folks can't really do it, but can there be litigation in a first-party claim? Yes, there can, especially in the auto law, okay? If I'm traveling back home tonight and an uninsured motorist hits me and I'm injured, I can sue my own company for my injuries under my uninsured motorist. If I'm hit by someone and I have injuries that are more severe than their coverage can pay, then I can sue my underinsured motorist coverage. So first-party claim can have litigation. So it just, that's something you have to keep in mind, that you're not always looking at claims folks aren't always looking, if it's a first-party claim, well, there's no litigation. You won't know there's no litigation involved until you delve into the claim. And it's like running an investigation. Don't make your decision until the end of the day when you have all the facts before you, or else you're liable to end up having to backtrack. Claims process, it's a little more involved than the underwriting process. There's usually 6 steps to it. The first is to acknowledge the claim and assign it. When the insurer becomes aware of the claim, you acknowledge it and you assign it. And under the regulations in Chapter 31 PA Code Chapter 146, it will outline these timelines, but normally the claim has to be acknowledged and assigned within 6 days of receipt. And then you have to communicate with the claimant as to timelines and what's going on with it. Second step the claims person has to do, of course, is to identify and confirm there's a policy. Okay, line it up on the policy. Now you're looking at the type of claim and the type of policy. So we'll just draw an auto policy. There's probably more auto claims than homeowners. Is the policy, is it in force at that time? If it's a first-party claim, is there physical damage on the auto that the person is going to claim? Did they strike an animal, so it's a comp loss, or did they strike run off the road and hit a pole or a tree? Is it a collision loss? Did they hit another vehicle? Now you have multiple issues to deal with, okay? Then you contact the claimant. Now, the claimant in this case can be you're insured, you contact them. It could be a third person. It could be their legal counsel if they've sought legal counsel. A good claims person is always going to contact their insured for their side of the story. You're not going to take just, if it's, your insured hits someone else, you're not just going to talk to the claimant. You're going to talk to all parties. You're going to try to get all of the information as accurate and as fast as you can obtain it so that you can make a decision on the claim in compliance with the laws. That's part of the investigation of it. Review the statements. Are there witnesses to the accident? Talk to the witness. Is there a police report? Obtain it. And the one thing that claims folks always seem to lose sight of on a police report, unless that police officer actually witnessed it, it's an opinion. They're taking a statement from the parties involved, and they're rendering an opinion as to what happened, and they're writing it down. They didn't see it happen. They're not a witness. But the police report will give you an idea. Maybe they're going to cite the one driver for DUI. Okay. Well, if that's your insured, you got sort of an uphill battle on that one. But it's still, the police report is not a witness statement. It is an opinion written by someone based on statements made by the people involved in the accident. Once you complete it and you have all the facts, then you take a look at the policy. Identify if the coverage actually exists to pay the claims. Like I said, all right, you have a property damage liability and the other party's car is damaged. They're not suing. They're not injured. They never, they got back in the car and they drove away. You hopefully have, say, $50,000 of property damage and the car's damaged to $10,000 or $15,000, you can pay it. If you have a minimum limit, $15,000, $30,000, and $5,000, you have $9,000. Someone's going to have to explain to that person why they're only getting $5,000 for their $9,000 damage. Okay. You're probably going to be the one as the claims rep to explain it. Okay, that the policy had less coverage than would cover for your loss. Ideally, if people buy the insurance that they should have, they can cover those losses. Then you have to look at your insurance card. Well, did they have physical damage on it? If they didn't have physical damage on it, you don't have any claim there. If they did have physical damage, then you have to judge that loss. If there was an injury to your insured, then you have a med claim issue. If the other person was injured, you may have subrogation to pay the med claim, and you may also have litigation for pain and suffering. If it's serious, it won't matter which tort election they have. If they got a couple bruises and went to the hospital and they were given some Tylenol and sent home, that may not rise to an injury under a limited tort option to seek non-economic loss. That's the other thing the claims person has to remember. Tort option only restricts ability to cover non-economic loss, not economic loss. So all of that takes into play, and then finally conclude the claim. Either pay what you're going to pay, deny portions of it, whatever's not covered, but communicate it effectively and clearly. And then be prepared for any follow-up on that file. Those are the 6 major steps of handling a claim.
Although, is there another step though before the first one you mentioned was acknowledge the claim and assign it to someone, but isn't the first one reporting the claim?
Well, the company doesn't report. The claims rep doesn't report it.
Well, I know, but isn't there a legal responsibility for the insured to report the claim within a certain period of time? And if they do not, then is the company obliged to respond?
Well, if they have, the insured has obligations to put on it. We're looking at from the company side only, but yeah, once the insured can call the agent to report the claim. I was involved in an accident last night. The agent should take some information, communicate it to the company. Some require timelines. Usually, the company doesn't want to sit and say, hey, I had a fender bender last October. Today, they probably would not deny it. But the company can still look at it and go out and take a look at it.
So it just kind of depends on the company?
Well, yeah. They may put the language in their policy that they have an obligation to do it. But, it's kind of tough to say if a person is injured and in the hospital, okay, and they have to report the claim within 72 hours, okay, and they're in the hospital for 5 days, the company's going to have to waive that because the person had no way to make the claim, okay? But I see what you're saying, but that's a step on the insured side.
Sure. But I thought I remember reading somewhere that if there's a hit and run, there's a 24-hour window to report the claim, something like that.
Well,
did I misread
if
that?
they will say that you have a hit and run should be reported to the police within 24 hours. Should be reported right away to the police. If you have your vehicle's damaged and you wait 3 weeks to say, well, it was a hit and run, you draw into how you're going to get the police report. They're going to base that on you calling the police coming out and writing that report. Okay. Yeah, you're right there. But see, these are steps on the insurance part. What they have to do, okay, I'm looking at the 6 steps for the claims rep is once it comes into the company, they don't know that there's an accident out there. Almost every company can sit back and say, yeah, we're probably going to get some claims this week. There's going to be accidents, okay? But they don't know exactly who. Those are the nuances to, okay, we had an issue when I was director of licensing and enforcement. We worked with, and I won't even give the names of the insurance company. There were 2 insurance companies we worked with, and we worked with the Philly Task Force. There was a body shop, and the guy had 2 locations of body shops, and the 2 carriers involved, and one of them is one of our larger domestics, and they were getting claims, and people were, the damage was being caused by collisions with deer, okay? And there were a couple of them. Now, I'm sure that on the Schuylkill Expressway and somewhere down in inner city, somebody might hit a deer once in a while. But the number of claims that were coming from this seemed to be out of balance, for lack of a better term. There was a producer and there was a physical damage appraiser. Of course, there are licensees of the department, so we get to investigate as well. We worked with the Office of Attorney General, the insurance companies, the Philly Task Force, and we prosecuted these folks for rigging the accidents. And what they were doing is they went out and apparently picked up a few deer off the highway. And then when someone would drive the vehicle in, they would smack portions of the deer up against the thing so that there's some hair on it or some blood or what have you. Now, like I said, 1 or 2, but when you're driving in downtown Philadelphia and you hit a deer, you've really accomplished something. Okay, so that's what they were looking at, because they're looking at where this vehicle was, where it was reported to the damage to have occurred, and the insurance company, the claims person, saying, I didn't know there were deer down that far. I didn't know there were deer down by the Liberty Bell. I didn't either. There might have been when the Liberty Bell, before it was cracked, but I'm not sure there was any. So we had that issue going on, and of course it led to criminal prosecution. So claims reps have to be cognizant of it, and the companies put these things in their policies to help the consumer, but also as an alert there. Okay, so yeah, you have that.
Now, another question. This is probably a real basic question, though, is that when you talk about litigation for pain and suffering or for any other reason, how does that square with Pennsylvania being classified as a no-fault state?
Well, we're really not. No fault was repealed a long, long time ago.
Okay.
You and I probably had brown hair at that time. We have basically, we're not a no-fault state. In a true no-fault state, you have an accident, you walk away. You go your way, you sue your company, they go their way, they sue. They're not determining fault. We're a fault state. But we are a state where if you're 51%, then your company may have to pay. If you're 51.49, you may be exonerated. You may also have to share in that on the damages. So what Pennsylvania really is a comparative negligence state. They compare the fault. I saw an interesting thing yesterday. I was coming back, and there's a shortcut that I can take off of Route 405 that'll take me over to my house. And it's on the outskirts of the little town of Montgomery. And they're laying a new gas line there. So, you get it. So there's a second shortcut you can take around to get, so you don't have to go through the construction, which is no big deal. You just have to drive about 25, 30 mile an hour. So this guy come out and apparently decided that he really wasn't interested in coming to a complete stop. And he made a left-hand turn. Well, there was a vehicle coming right there. So I could see it. Okay. And they didn't miss by much more than the distance between Ron and me, and we're sitting side by side. Now, in a comparative negligence issue, yeah, the vehicle that was on Route 405, it was a red vehicle, could have stopped, could have slowed up and avoided the accident completely. Had they not done that, had they actually hit that vehicle, yeah, the other person was wrong for turning out in front of them, but they could have slowed up. So when you get into a comparative negligence, the companies may come down to say, wait a minute, the guy's carrier who made the turn, he said, we're not taking all this at 100%. Your insured was seen to not even to have made an attempt to avoid the accident. Okay, so you have to understand that in Pennsylvania, we're comparative negligence. So will litigation evolve? It could, but if you are 51%, probably get closer to 50, you're not going to be able to sue. You're going to have to be deemed the lesser of the two responsible parties in order to bring litigation to recover. And then again, if you're going to recover non-economic loss, it's going to have to be pursuant to your tort option, or your injuries, if you're a limited tort, are going to have to be what are deemed as severe. So messing up a hairdo is not severe. Okay. All right. Just a quick overview of what the claims department might look like. Claims managers, claims supervisors, claims reps, and specialists. These are the typical people that get involved. Not saying that the producer doesn't get involved in the claim, not saying that the underwriter might not get involved in the claim, but just to give you an overview of what they are. A claims manager, let's keep this on a little higher, shorter level. Claims managers are usually direct the operations of the department. They're not going to get into the day-to-day activity too often. It's going to have to be something where it gets extremely complex. Drawing on that would be like Ron was a deputy commissioner. I was a bureau director. We did not get involved in the daily operations. We had division chiefs and staff that handled the day-to-day operations. We handled the senior issues. Ron would have been working like 6 to 8 months out, and I'd have been working 3 to 6 months out on projects and things of going on, budget, staffing, things of that nature. So that's what a claims manager, they're directing the operation. They have the responsibility to make sure staff get developed properly so that they have the knowledge, they're up to date on existing laws changes, manage the expenses of the operation. That's what the manager is going to do. The supervisor, they should, in generality, be overseeing the claims representatives on the day-to-day performance. They're going to run the day-to-day operation. The supervisor is. And the claims rep is going to handle the claim as it comes in. That would be like your 3 tiers there, the manager. Now, we're looking at the claims manager as the manager. I'm not talking about guys that are VP of claims and VP of operations and things of that nature. They are like the executive staff. You get a vice president involved in a claim, you probably got a pretty high-profile claim. But usually claims managers, if it's not being settled at the first level and the supervisor can't place, maybe the claims manager is going to get involved in it to try to settle the claim and put the issue to rest. But normally the supervisor or the rep is going to deal with the claim. If litigation is involved, you may have to go to specialists, okay? In homeowners and property policies and things of that nature, you may have to get a cause and origin investigator in there. How did this fire start? There's no explainable reason why this fire started. What happened? And you get a cause and origin person in there. If the fire marshal, some use the fire marshal's report, but getting the fire marshal to testify in your litigation may be a little more difficult, so you send in a C&O specialist. Okay, if the person's injured in an auto, you may want to get a medical review of it to determine the guy does have some injuries, but he can't work. Says he can't get out of bed. But the other day he was out playing touch football with his kid. So it's a little bit tough. So you do that, and you'll run into that even with workers' comp. You're going to run into specialists doing that. You have damage to a building, you might want to get an engineer in there, structural engineer, to determine the extent of the damage or the extent of the repairs necessary, or maybe you don't want to repair the building, you want to demolish it. So specialists get involved when the claims are really complex. On a general fender bender claim, you're probably going to deal with just the 2 parties. That's the quickest overview of that.
Although, what role do adjusters play in that process?
Well, they're like when you're talking the claims adjuster, well, they're like the claims rep. They're handling the claim. Different titles may apply to a claims rep. May be in-house and never leave the insurance company's office. So they're an in-house, and you get an adjuster on the outside. Some companies do not have field adjusters. They'll use independent adjusters. But that independent adjuster, when they're out there, is basically considered to be working for the insurance company. So if they're overextending the law, stepping on the law, the insurance company is going to be called to task on it. But yeah, you're talking about like field adjusters or physical damage appraisers. They're out in the field, but they are claims reps. But the normalcy is the inside claims rep doesn't go anywhere, and the outside claims rep is usually referred to as an adjuster. There may also be telephone reps at the company that contacts so that the claims rep doesn't have to field every phone call, or even they can direct the phone call if the person's calling in with a question to maybe a supervisor who's been handling it or whatever. Producers play a part. And some carriers will even give draft authority to producers. Usually it's a pretty good sized agency if you're going to let them handle a claim for you, but it's going to be restricted. They may be able to pay a towing claim. They may be able to pay a small collision or comp loss, maybe up to $2,000 or something like that. No company, to my knowledge, has ever given an insurance producer agency the ability to settle a litigation claim, liability claims. That I've never seen it. Now, that's not to say that they haven't. We're not talking managing general agencies. These are just your typical agencies. When you get into a managing general agency, that's a whole different animal that is registered, and they actually are an arm of the company, and they may be able to settle claims. They can, even under the Pennsylvania statute, cede reinsurance. So they operate differently, but you're not going to find those on every street corner. But typically, your draft authority is going to have a limit. Some companies, depending on their comfort with that agency, may go $2,500. Some may go $5,000. But it just saves the carrier time. A lot of carriers will also use, and I know this has been a hotbed for some places, especially for the Body Shop Guild, but some carriers will utilize what they call direct repair facilities or direct repair shops. And what that basically does is, if I ding up my vehicle, it's drivable. I drive it to a direct repair shop. There is a licensed physical damage appraiser there. They write the appraisal from my carrier, their DRP from my carrier. They write it, they fax it up to my carrier, and 9 times out of 10, the carrier says, go right ahead and fix it, because there's an agreement there, okay? Since Ron mentioned the former Commissioner Joe Ario, Ron and I and Commissioner got called over to the House on an issue about the use of direct repair facilities. And I will give Commissioner Ario credit for this, although there were times that things that he said caused me a lot of grief in my position. This time he actually said to a state rep, one of the best explanations for having direct repair facilities that I ever heard. He said, in the health market, we have HMOs, and we encourage people to use these managed care programs to contain costs and get better service. He said that's all a direct repair facility does for the auto side. It gives you control on the cost, and the people get served better. That's one of the best. And I'm going to say this occurred like in 2008. And so I've remembered it for the past 8 years, because that was one of the better explanations of a DRP that I ever heard. But yeah, so you have, so even involved in the claim, it may be even an auto dealership. There's no restriction on how or who can be involved, as long as the claim is handled in accordance with the law. But keep in mind that the claims are supposed to be paid under the policy. They're supposed to be paid fair, and the company's capacity to write more business, the company's viability to stay in the market, depends on paying claims properly.
But of course, the companies can't steer business to their network.
The DRP? No.
If the person wants to go to a private body shop, it's very clear that they have the option to go where they choose.
Correct. It is. There was, and I know Ron will probably remember this, because we got tasked with doing it, and we actually did sort of a data thing, and we asked the top 10 writers, top 10 auto writers in the state, which had like 80% of the market, and it was like 30% of their claims, their auto physical damage claims, were handled in DRPs. 70% went to independent market. So if they're steering, they're not doing a very good job of it.
So Jack, I have a question on the claim side. Pennsylvania currently does not license company adjusters.
Correct.
Are there states that actually do license them?
Yeah, there are, and that's been a bone of contention in Pennsylvania by the public adjusters, that they have a license and the company adjusters don't, and some other companies. But what we've always done is we've looked at the claims itself. Okay, when a consumer goes to a public adjuster, they're hiring that public adjuster. That's the licensee in the mix that is handling it for the consumer. If the consumer is solely working with an independent adjuster or a company adjuster, they're working for the company. The consumer's working with that company. So in that mix, there's always a licensee that is dealing with the consumer. And that's why we've never really felt the need, because if the company is not handling the claim in the appropriate manner, paying the claim as they should, we're going to deal with the company under the insurance laws. And it becomes the less people that you have involved that you may have to take action against, the more focused your action to correct the violation becomes. Because if you end up with, well, I had three adjusters involved, so you got three licensees plus the insurance company. Well, that one did this one did that, and you end up with finger pointing. Without the company folks being licensed as a company, we don't care what your people did. Ultimately, you didn't do this right. So that's always been how we maintained it, but you never know when the laws will change, but that's always been that way.
Now, there's one other thing, too, that I think this is current to the legislative landscape in Harrisburg. My understanding is that Representative Tobash put a bill that passed the House that would allow for some type of remote imagery as part of the adjusting process. And I understand that that's attracted more than a few sparks along the way. Is that something you've looked at, or what impact would that have on the claims adjustment process?
We were asked that. The thing you have to remember is the present physical damage appraiser law was written in 1974, 5 timeframe, 71 timeframe, somewhere back then. And the last time that statute was amended was probably back then. The regs have been amended a little bit, but it's the statute that says you cannot use photographs to make a determination of the damage. Well, we've come a long way. You can take a picture of somebody today that looks like sin dipped in acid and make them look like a beauty queen or a star. Okay, so I know everybody around here laughing, but the fact is, photograph imagery today is so much more. It's just like the internet. Okay, 25 years ago, almost no one even had a computer. Today, everybody has one in their pocket, their iPhones, their smartphones. So you can take photos with it, and if you're probably not going to be able to determine a total loss from it too easily on smaller damage. Okay, but if there's nothing left, I saw some of the scenes from the Act 78 accident last week. There's no doubt in my mind some of those vehicles, there's no way you're going to repair them. They're hit from the front, the side, the back. So the adjuster takes that and shoots it off to the company, and within 4 days, the person has their check. Whatever. If they have a loan on it, it's cleared and everything else. You got a couple fender benders. Okay. Usually what happens is there's hidden damage in some of the more minor collisions, and then you have they have to go back and they have to do a subsequent appraisal. That can still be done. Just take a photo. If the photos can be relied upon to give an idea, and then the company would have the right to say, I think we better send somebody out there. And I believe that that's what Representative Tobash was driving at is, we'll use a photo to start, but the company, before you make your final decision, if you feel necessary, you have to send it out there. And in no way should they use a photo to make a determination if the vehicle can be returned to roadworthiness solely on the photo. If it's damaged that badly, then you should send somebody out to take a look at it.
Okay, Jack, I have a question from one of our viewers,
Okay.
And it has to do with something you said earlier. Can you explain and give an example of what you mean by non-economic losses?
Non-economic loss, okay. Non-economic loss is pain and suffering. So I'm involved in an auto accident, and I have my hip is dislocated, and I can't work. So now I'm going to sue, 1 for the pain and suffering, 2 for the lost income. Well, the lost income may actually be an economic loss, but the pain and suffering, if I'm going to be inhibited by it, I lose 10% of the use of my leg or my hip. I can't play sport, whatever. that's non-economic loss.
Now, and that applies to both the homeowner's policy of the third-party claimant that may be injured, as well as in the auto world, correct? Where whether the policyholder or a third party is injured.
Yeah, I mean, it's gonna come up more in the auto, but in the homeowners, usually there's a coverage for liability and a coverage for med pay to others. So if, I got a friend of mine and he's helping me, we're putting in a new floor in the sunroom, and, somehow he gets hurt, no matter what.
Right.
And so he goes into the hospital, we can pay the $500 that they did the x-ray on. He's not injured any great degree, signs a loss for the company and release, and he gets medical bill paid.
So to a follow-up point of clarification, is non-economic losses generally limited to just personal injury type of situations?
No, if you lost your job because you were injured, say you were off for 6 weeks, didn't have leave, and they terminated you, you could probably come back and sue for your income.
Okay. So in this,
because you didn't lose it, you didn't lose the income because you weren't working, you lost the job, and that would be a non-economic.
Okay. So
you lost
it isn't just simply an injury to
right.
your body. It could have been some other reason.
Oh, it'd be mental duress.
Economically hurt. Okay.
Or it could be the psychic trauma that comes with the fact that I can't carry on my life as I did because I've been traumatized by whatever happened.
Right.
And
Well,
then,
you could have injuries to your eyes.
And then you let the court decide.
Right. Yeah.
If there's a psychological damage.
Well, let's say you injure somebody and now they go from not wearing glasses.
This is a personal injury.
Right.
It's just limited to personal injury.
Right. Personal
Clearly,
injury.
personal injury, there is a non-economic loss.
Correct.
We know that.
Right.
But there are other forms of non-economic losses,
right.
such as a situation where, as a result of an illness, you're saying, you can't work for a while, so your company lays you off and fires you, whatever. You may have a right to recover against them for your economic losses if it wasn't an appropriate fire. Okay.
Well, one that did actually happen, and this you could relate to this because you were in the Air Force. Okay, there was an accident a number of years ago that I read about and the injured party suffered a concussion, and then he lost his 20/20 vision, and he had to get corrective lenses. He didn't go blind; he just had to get corrective lenses. However, he was an Air Force pilot. Now he's excluded from flying, so he lost his position as a pilot, and that's a non-economic loss. He didn't lose his job; he still was an officer in the Air Force, but he lost his flight pay. He lost his pursuit that he enjoyed the most. So that non-economic loss you can sue for. So yeah, it doesn't have to be a permanent injury. In this case, he can still see. Just has to wear corrective lenses.
Can we go back to a question Vince brought up earlier about the spark of debate that's going on in the General Assembly right now related to the auto appraisal law itself? So the argument is that the insurance industry says that technology has improved to the point now where we are comfortable being able to pay certain types of collision through the use of pictures and other things. And there's already a mechanism in place in the event that there is some hidden damage that goes on. So therefore, the consumer is made whole. However, the question I have is to receive an appraiser's license. Can the appraiser actually receive that license when they have to do the practical part of the exam by reviewing photos of vehicles that had been in collisions?
That's actually what they do. The motor vehicle physical damage appraiser exam is 2 steps. It's 1, theory, which is the law. They answer the questions. And then 2, prior to about 2012, maybe 11, somewhere around there, they used to go out to a facility in Mechanicsburg and walk around a damaged vehicle. The facility could only handle like 12 people at a time, and they operated like 4 days a week, so they couldn't get the candidates in like And if everything else, the person passes the first part, then they have to make an appointment. So there may be 2 to 3 weeks so they can, what it was causing was a delay to get people into gainful employment and get the license in their hands when it was due to be there. So we tasked our vendor at the time and worked within the department in that and developed the test online. So yes, the test is actually administered in an electronic environment. So they're looking at damaged autos, making a determination on a computer as to what they would think. Now, so we're using the technology to give them the exam. It doesn't sound logical that you wouldn't be allowed the technology to use in the marketplace. Usually it's the other way around.
Well,
It comes out of the marketplace to us first, but in this
that's
case,
what the General Assembly is getting paid to figure out, what should and should happen. We've run the full hour and a half. I know we're not completely done yet. So what I'd like to do, Jack, is have you either sum up or complete what you wanted to chat about, and then if there's any, we'll take another 5 or 10 minutes.
okay, well, the last part of the claims process is basically the same as the underwriting process. Somebody's going to have to measure the performance of the claims department. They use the same financial resources, okay, loss and combined ratios. Okay, we're taking in X number of dollars in premium. We have Y number of dollars in earned premium. And if they're paying out more than someone in the claims department, they're going to have to look at, are the underwriters doing a bad job? Are we paying claims we shouldn't get paid? Are we, in the cases of litigation, are we offering more than we should be offering? Are we just trying to settle? Somebody's going to have to do the evaluation. They use the same tools, financial and non-financial, interviews, staff reports, performance evaluations on the non-financial. On the financial, cut and dry, you're going to look at loss ratios, combined ratios, expense ratios. How much is it costing us to do this? Are we pulling in legal people and paying higher legal expenses than we need to pay just as a precaution? Maybe we can cut costs there somehow like that. Same thing as you do for underwriting. When it comes down to the end of the day, the operation of the company hopefully is profitable. And in Pennsylvania, the bulk of them do remain profitable. The company, once it gets up there a little bit, has to start raising premiums. That can have, that may have a negative effect. There's a lot of people, if their premium goes up 20 or $25, they start searching for another carrier. And one of the things the carrier makes money on is retention. Most carriers do not make any real profit in the first year premium because so they pay all the expenses for that are incorporated in underwriting for painting all the reports. They pay the commission to the producer. They pay the printing of the policy, everything else. They're really not making any money on the first year, so they've got to retain the book of business. So they got to have good underwriting and they got to have good claims managing.
You get one more question.
Okay, here's my question. Jack, would you consider doing another series like these? These were very, very instructive, very helpful. There's my last question.
Ron could probably talk me into it somehow, some way, as long as I at least get a little bit of fly fishing time on Penns Creek, Low Oil Sock, and Lycoming.
Well, with that, I want to thank you folks for participating in the Virtual Insurance School. It was PAMIC's first foray into this virtual world of education, and we're learning as we go along. We're going to be asking you for your feedback to help us do a better job in the future. Before I sign off, I just want to remind folks that the annual spring conference is quickly approaching for March 8th in State College, PA. And, if you're able to attend it, it's going to be a great opportunity. We actually have a packed event that same day with both Senator Jake Corman, who is the Senate Majority Leader, and with Representative Tina Pickett, who is the chair of the House Insurance Committee. So we have a great opportunity to talk to some of the public policy leaders that affect our industry. With that, I want to say thank you once again. This production will be posted on the PAMIC YouTube site called PAMIC Live. So if you want to review some of that information, you can see all of the segments there. Once again, thank you very much.